The silver market just flashed a signal that usually only appears during major financial stress right now. There's a massive gap between paper silver and physical silver, and investors are starting to notice not if silver on COMEX is trading around $29 per ounce. Then why are people paying nearly $36 for actual physical silver? That's not a normal premium anymore. That's a warning sign. Welcome to Finance Rafay, where we break down the hidden reality behind the financial headlines. In today's video, we'll cover what silver premiums actually mean. Why a $7 premium matters so much, what history tells us about these moments, and what could happen to silver prices over the next 3 to 6 months. Let's break it down. What is a silver premium? A silver premium is the extra amount you pay above the spot price when buying physical silver. Simple formula: physical silver price equals spot price plus premium. Spot price is the paper price you see online or on COMEX futures markets. But when you actually buy real silver coins or bars, additional costs are added: minting cost, shipping and distribution, dollar profit margins, and most importantly, supply and demand pressure. Normally, silver premiums are $1 to $2 for generic silver bars, $3 to $4 for government coins like silver eagles or maple leafs. But now, premiums have exploded to around $7. That's highly unusual. If COMEX silver is trading at $29, paper silver price equals $29, physical silver price equals $36. That means investors are paying almost 24% more just to own real metal. The market is basically saying physical silver is worth far more than the paper price suggests. When premiums rise this aggressively, it usually means physical supply is tightening. Dollar inventories are shrinking. Demand is overwhelming. Available supply in the paper market is no longer reflecting physical reality. That's why many investors are starting to believe the spot price feels fake. The real market is physical silver, paper silver versus physical silver, paper silver, silver exposure through futures contracts, ETFs, or digital trading instruments, physical silver, actual silver coins, bars, or bullion you can physically hold. The paper silver market is enormous. Hundreds of millions of ounces are traded daily on COMEX, but most of those contracts are settled in cash, not real silver. The physical market is completely different. It requires real bars, real coins, real delivery on. That's where the disconnect is happening. An investor holding a silver ETF like SLVC's silver valued at $29. But if that same investor wants to convert into physical silver, they may have to pay $36 per ounce. That price gap is creating confusion and distrust. Retail investors are increasingly choosing physical silver over paper products because physical metal can be held directly. It carries less counterparty risk, and during crises, real assets usually matter more. At this shift toward physical ownership is one of the reasons premiums keep rising. Why a $7 premium is a major warning signal when silver premiums rise 3 or 4 times above historical averages. It becomes a structural warning signal. In the past, premium spikes happened during temporary events. The 2008 financial crisis, 2020 pandemic panic, the 2021 Reddit silver squeeze. A bit today's situation feels different. Now we are seeing dealer inventories collapsing, delays growing, mint production struggling to keep open, institutional demand increasing. This looks more structural than emotional. Major silver dealers like APME XJM Bullionaire reporting delivery delays of 2 to 4 weeks. Normally, delivery takes only a few days. That's a strong sign of supply pressure. If premiums remain elevated for a long time, 3 possible outcomes could happen. Scenario 1: paper prices catch up. Paper silver prices rise toward physical silver prices. Scenario 2: premiums collapse, demand weakens, and premiums fall back to normal. Scenario 3: market system stress. If delivery demand becomes extreme, COMEX credibility could come under serious pressure. Most silver bulls are Betting on scenario 1, the COMEX problem. COMEX is a futures exchange where silver is mostly traded through paper contracts. The problem begins when paper claims become massive but actual deliverable silver remains limited. There are far more paper claims than real physical metal available for delivery. That imbalance creates risk. Imagine 10 people all claiming ownership of the same ounce of silver during normal times. It works because most never ask for delivery. But during periods of fear or shortages, people start demanding real metal and the system gets stressed. That's why physical ownership is becoming more attractive. The more investors move from paper silver into physical silver, the more pressure builds on the physical market and the longer premiums may remain elevated. This situation could become extremely bullish for silver prices if the disconnect continues. What investors are doing right now. The market seems divided into 3 groups. 1. Physical buyers, people paying high premiums to secure real silver. Now, 2. Waiting investors, people expecting premiums to fall before buying. 3. Paper holders, investors staying in ETFs or futures while monitoring the situation. The most interesting part is this: fear of shortage is actually creating more shortage. As investors see lower inventory is longer delays rising premiums, they rush to buy even more physical silver. That creates a powerful feedback loop that can push premiums even higher. The silver market may be approaching a major turning point. A $7 premium is not just expensive silver. It could be a signal that physical demand is becoming extremely strong. Confidence in paper pricing is weakening and the paper market may eventually be forced to catch up with reality. Now, the big question is this just temporary panic? Or is this the beginning of silver's next major breakout? Comment below and let me know. Are you buying physical silver despite the premiums? Or are you waiting for premiums to normalize? And if you enjoy deep financial breakdowns like this, subscribe to Finance Rafay, because here we don't just follow headlines. We decode the real story behind the market.